Welcome back, everyone. Today we're going to continue with Chapter 9 about purchasing, financing, and insuring a home. We are going to continue with how to decide how much house we can afford. Let's get started. In the last video, we talked about 3 criteria that we can use to determine whether or not we can afford a particular house. The first criteria is comparing the house value to your annual gross income. We'll call that the house value multiple. Basically, the house value multiple is computed as the house value divided by your household annual gross income. The benchmark is that we want this multiple to be less than 3 to 5. In other words, we do not want to buy a house that's more than 3 times your annual income or 3 or 5 times your household annual income. The second criteria is the housing cost ratio. In the textbook, we talk about housing cost burden and how expensive and unaffordable housing has become in America in general. A household is considered house burden if their house cost is more than 30% of their monthly gross income. And housing cost is defined as your mortgage payment, including private mortgage insurance or other kinds of insurance, plus property tax, plus insurance premium, plus any other condo fee or HOA fee, plus your utility. So this is your total housing cost. So this is how much it will cost to keep you in a home. The housing cost ratio is computed as this total cost that we add up together divided by your monthly gross income. And the benchmark is to keep this housing cost ratio to be less than 30% so that you will not become house burden. The third criteria is your debt to income ratio, so your DTI ratio. Your total debt payment is defined as your monthly mortgage payment, again, plus your property tax, insurance premium, condo fee, and any other monthly debt payment. If you add up all this, the estimated DTI ratio is the debt payment criteria divided by your monthly gross income. And the benchmark is to keep this DTI ratio to be less than 30 to 35%. By selecting a house that satisfies all 3 criteria, we ensure that you will be in good financial shape and be ready to take on a home owning responsibility. Let's take a look at an example on how we can apply this common sense and these 3 criteria. This example is based on the Maya and Isis from the textbook. If you have, I encourage you to pause the video and then go over to the textbook and read their entire example to get a better idea of their situation. Since we have 3 criteria that we are considering, and we do have a lot of calculation to do, to ensure that all 3 criteria are satisfied, the process is iterative, meaning that we may try one number and it may satisfy the first criteria, but then you may not satisfy the second or third criteria. And we have to try different numbers to determine exactly how much house you can afford. To make our calculation a little bit easier, we're going to use a spreadsheet template. The Google slide provides a link to the spreadsheet template. You can download this template and then upload it back into Google Sheets to do the calculation. You can also use it for your own analysis in the future. This is a relatively sophisticated template, so I'll take a minute to explain what all this color coding meant. The pink highlight are the recommended criteria. So we have the 3 criteria that we mentioned in the book. The first is the multiple. We want our house value to be less than 3 times our annual gross income. The second is the housing cost affordability ratio. We want that to be less than 30% of our monthly gross income. And we want the debt payment to income ratio to be less than 35% of our gross income. The areas that is highlighted in green, this is to be entered by user. So this is where you will enter your own personal specific information. The data that I've entered here represents the case for Maya and Isis. So this includes their their annual gross income, their other monthly debt payment, how much they have a down payment, the utilities they expect will be, this is the future utility, not their current utility. This is the future utilities if they do buy the house, any fees for condo or HOA. This is the housing insurance premium, property tax, whether or not they'll have to pay PMI or other types of mortgage insurance. In the book, we talk about there are other types of mortgages, and some of them come with their own insurance fees. What the mortgage rate will be, the time of the mortgage, so 30 years, and what is the closing cost. We use 5%. This is a national average amount. This model will compute all the ratios, including the housing cost ratio and the DTI ratio. As you scroll down the template, you will see all the calculations. It also includes all the formulas that is used in the calculation, so you can examine how this is constructed and perhaps even construct something on your own if you want to customize it. In here, it computes the housing cost ratio, the DTI ratio, and then further down, you also check criteria 1, whether the housing multiple. The way that you use this template is you enter all the given information. Here are the information given in the example in the textbook. Maya and Isis has an annual gross income of $132,000, and they also went to their credit union and they were pre-approved for a $360,000 loan. After entering all the information they have collected, some of them is from the credit union, some of them is from their realtor, and the estimated PMI and insurance and interest, those are from their mortgage company, and also closing costs. They use what was provided in the textbook as an estimate. You can enter the pre-approved amount to start. So their pre-approved amount is $360,000. Once you enter this amount, the model will compute the monthly payment. So this is monthly payment before PMI. And they estimated the PMI premium per month, which is $300, and it gives you a total mortgage payment, including PMI, of $2,458. In addition, they have utility, condo fee, homeowners insurance, and property tax. So adding all those together, this is their total housing cost, which is $3,663. Comparing their housing cost to their monthly gross income, this is their housing cost ratio is 33%. They can also compute their total monthly debt payment ratio. Their total monthly debt payment include mortgage, property tax, as well as other loan payment, but does not include utility. In this case, their DTI ratio is 35%. We'll then compare the value that is computed against the criteria. The criteria for a housing cost ratio is to be less than 30%, and for the DTI ratio is less than 35%. So if you scroll down further down in the model, it'll tell you that no, the housing cost ratio or the DTI ratio is greater than the recommended value. So this is not affordable at this point. It is for the housing value ratio, so 3 times the multiple. So the housing value that they can afford is $382,000. That is less than the earnings multiple, the housing cost multiple. The housing value multiple at $382,000 is around 3, so that satisfies their criteria. Here's when the trial and error begins. They know that they cannot afford a $360,000 mortgage. So how much can they afford? So what they can do is change this number. So if they cannot afford $360,000, we can try $350,000. And that is still not affordable. So we can go down, let's say we go down to $300,000. That satisfy all the criteria, but can they borrow a little bit more? So let's try $305,000. That's still good. So you can keep trying until you find out what is the maximum amount that still satisfy all your criteria. We find that at $306,500, everything is still good. But if we go up to $307,000, then that is too much. So we'll stick to $306,500. So that's how you would use a template and do trial and error to see how much you can afford to borrow. And given their down payment, so they have $40,000, they have to pay closing costs, and then whatever is left is their down payment. It turns out they can afford a house of $331,500, and this housing amount and this loan amount, so a house of $331,500 and a loan amount of $306,500 will satisfy all three criteria. Here is a summary of the different loan value that Maya and ISIS have tried. So they started at $350,000. That is too high for, remember, the housing affordability ratio. We want this to be less than 30%, and we want the DTI ratio to be less than 35%. So you can see that they can afford up to $306,500. Maya and ISIS decided that they want to be a little bit conservative, so they wanted to try for a loan amount of $305,000, which they know is within their criteria. This is affordable for them. And given their $40,000 savings and a $15,000 closing cost, they can put down $25,000 as down payment. They will allow them to buy a home up to $330,000. And the down payment, $25,000 down payment, is 7.58% as a down payment. That is not the highest, but it's also not the lowest. It's over 5%, which will satisfy many loans. Ideally, it'll be 10% or even 20%. But given the housing costs and how much they have saved, they can choose to wait and save more money, or but at the current time, they can afford a house up to $330,000. The total amount they need at closing is the closing cost plus the down payment, which is $40,000. In here, you can see that the restricting factor for Maya and ISIS is not the DTI ratio. The DTI ratio is less than 35% in all the cases that they have tried, but rather is a housing affordability ratio. When looking at the house value multiple, the rule of thumb is 3 times the estimate. So that would be $396,000. Maya and ISIS, their estimation from their worksheet is $330,000. So that is well within the 3 times multiple. So in this example, the restricting factor for Maya and ISIS is the housing cost ratio, not their annual gross income and not their debt to income ratio. We will end this video here. I encourage you to go to the template and try it out and experiment. In the next video, we're going to go over different types of mortgages and also explain what an amortization table is. See you back here soon.